Welcome back, folks, to Investor Diaries. Over the last 2 months, the equity markets have been really volatile. And in fact, a lot of those high flying stocks have had a steep fall from where they were in December of 2020. In this video, we are trying to make some sense out of what is going on, and we'll come up with 5 things that you must do during these uncertain times. So, without further ado, let's get right into it. Nidesh, where do you like to start off this conversation with?
Yeah, sure. So first of all, welcome back, folks, and thanks for having me on the show. So I would say like, one of the first things to keep in mind is always allocate some part of your portfolio to cash. Now it's hard to predict what percentage, how much cash you need to keep, or what percentage of your portfolio it needs to be. There are some portfolio managers who would recommend to go 10% cash. Some would say 20% cash, depending on the scenario, depending on the market at that point in time. But always keep some percentage to cash. It all depends on the risk allocation that you have, or the risk bearing capacity that you might have. But definitely keep some cash. The reason we say that this is important is nobody knows which way the market's going to go in tomorrow or in a week. But overall, over a period of 30 years, it's going to go up. So whenever there are down days, like a red day, you need to have cash to be able to invest it. Now, if you've invested 100% of your cash in portfolio today and tomorrow it goes south, you've lost that opportunity. Your opportunities reduce. So that would be the first point that I would say.
Yeah, and to build on to your point, when you're managing such a cash position, I think you should keep investing. So this might be a very unpopular thought during these times, that the market is volatile and we are recommending that you should keep investing. But yes, you should keep investing, but in small chunks during this time, because no one knows for sure what the future of the market lies. We don't know where the stock market is going to be in 2 days' time, forget about 2 months' time. So that is the reason, if there is a bull run at this point of time and you don't invest and you don't participate in the market, you will lose out. However, because the markets are volatile, it's important to invest in quality names. So these would be companies that have strong earnings and good reputation, and then invest it in small chunks, so that if the market goes down south, you have some more cash and then you can buy some more. I think this is going to be a good strategy which is going to help you in uncertain times like these.
Yes, and just to build on to the second point that Appy mentioned, one key concept that I'd like to highlight here is dollar cost averaging. That that has stood the test of time in investing, and it's a very powerful concept. What it means is essentially you buy, let's say, 10 stocks of Apple today. It's about at 122. For simplistic purposes, you buy it at 100. Tomorrow it's at 101. You've bought again some couple of stocks, and your average cost has gone up. But day after tomorrow, it goes to 110. You are still making some money, right? So the key point is you can either go dollar cost average up, or you can go dollar cost average down. Dollar cost averaging is a very powerful concept, especially in today's times when you do not have to pay commission to the broker. So going back to Appy's point, you can keep investing in smaller amounts. You can dollar cost average. You can reduce your cost when it's going down. Let's say a good quality stock name like Apple or Microsoft. Today, if it's on a red day, on long term, these companies have good quality of earnings. These companies are going to do well over 10 years. So you would like to take the opportunity to dollar cost average down when it's on a red day, to reduce your average cost position on such good quality names. So keep that in mind, and do make use of these free or no commission trading platforms to dollar cost average up.
So Nidesh, as far as dollar cost averaging is concerned, you're saying I shouldn't be afraid to dollar cost average up or down, right? Because if I think that the company that I believe in has strong earnings and the company has had a fall because of economic parameters outside, it's eventually going to do well.
Yes, exactly. So the fundamental premise is on an average, on a long term horizon, a quality company is always going to do well. Like we all know, for like, let's say at least in the next 5 years, Microsoft is still going to be around, Google is still going to be around, Apple is still going to be around. So if you firmly believe that this company is going to be around for some time, you firmly believe that this is a good quality company, they're still going to be relevant in the market, they're still going to be dominating the market, then yeah, you should for sure keep investing small, to the point that Appy said, and dollar cost average your position either up or down. So never be scared to keep buying.
Yeah, and that was a good response. I'll pick your brain through one more question on dollar cost averaging because that's really important. Nitish, does it really matter what kind of stocks I'm looking at as far as dollar cost averaging is concerned? Like I spoke about good companies with solid earnings. Like, does it have to be an out and out growth company? Does it have to be a value based company? Or it doesn't really matter as long as you think that the company has good future prospects?
Yes, I don't believe it matters at all, whether it's a value company, whether it's a growth company, as long as you firmly believe that the company is going to be relevant in the near future, at least, because we probably don't know what the world is going to look like 10 years down the line, but at least in the near future, you think the company is going to be relevant, then yes, do dollar cost average up. You should make use of the opportunities that present themselves.
And before we move to our fourth point, the other question would be ETFs versus stocks, right? As far as dollar cost averaging is concerned, would you say that the concept can be applied to stocks as well as ETFs?
Yes, that's a very good point that you call out, and yeah, it can be applied universally, right? It can be applied to ETFs, stocks, bonds, whatever. Essentially, what you're doing is buying the particular name, whether it's a stock or ETF, at regular intervals. So you make sure you build a larger position, and if let's say Apple has been on a tear for a long time in 2020, but in the last week it has dipped, but you firmly believe that Apple is still going to be relevant in the next 2 years and it's still going to do well in the next 2 years, right? You make use of these options and buy at smaller chunks, right? And again, tomorrow Apple could again dip, so you buy again a little more, you build a larger position, and in next 2 years it's going to do well. And I also want to touch upon this. The ETFs, what Appy brought about, is also a very powerful way to dollar cost average up, because there are a lot of brokerages out there who do not who charge commissions on stocks but do not charge commissions on ETFs. So that's again a way to keep investing on smaller chunks on the side. You can keep buying like one stock or two stocks every day, if you firmly believe the company is going to do well. And again, some brokerages also offer fractional shares, which is even better to dollar cost average out.
Yeah, I think that was really insightful, and thank you for sharing so much of light on dollar cost averaging. Now that we are speaking about that, the next point is do not panic sell. Now, this is really, really important, because what's been the evergreen aspiration as far as stock buying is concerned? It is that you should buy low and sell high. But in reality, it takes a lot to accomplish that, because the moment the stocks actually start going low, the stock market has seen 2 days or 2 red days, people start panicking, and at that point of time people make the mistake of selling the stocks, and this goes directly opposite to what we at Investor Diaries have been recommending, that you should be investing in quality companies. So as an example, we can possibly look at some of the indices. So the most famous one that comes to my mind is the S&P 500. Now, if I look at how the S&P 500 has behaved over a period of last 20 years, you will see that there have been dips in place. However, having said that, you'll also see the market has continued to go up. As an example, the market right before the crash of 2009, which is the financial crisis, was at about 1500. That's the S&P 500. Today, it is close to 4000. Now, this basically goes on to show that yes, if you buy it at a particular point of time and then there is an economic collapse, then yes, you will see your portfolio go in the red. But don't lose hope, because You are buying good companies and they are going to go up. So if you panic sell, then it means that you've made a loss already. Don't let that happen to your portfolio.
Right. And again, the premise is on a long term horizon, your investments are going to do well. Just again, closer to our memory, if you had invested right before the peak in 2020 and let's say Feb of 2020 and the market went south on March, today you would still be, your portfolio is still going to be up like at least 10 to 15%. So had you not sold in that panic moment, you could have still made money today. The next key point that I'd like to talk about is to consider a barbell approach. Now, a lot of seasoned investors have been always recommending a barbell approach. What this means is essentially portfolio customization and make sure your portfolio is balanced. Now, I would not recommend a percentage allocation. That completely depends upon your risk appetite and your risk bearing capacity. It could be 50-50, 50% growth stocks, 50% value stocks, or it could be 80-20. You could go like 80% growth and 20% value. But the key thing is to have a well represented portfolio of the market. The reason we suggest that is most often there are some sectors of the market that are underperforming and some sectors are performing well. Like this past week, value has been going up while growth has been kind of dipping and taking a break. So in these circumstances, if you had value stocks in your portfolio, and when we talk about value, we're talking about industrial companies, banks, etc., you could have participated in some upside. At the same time, keep buying growth companies and dollar cost average your cost down.
I think that's a really, really important point. And while trying to pick up stocks, and this is just a general piece of advice, is you should buy the companies that you know a little bit about. That is going to help you, because if the company takes a decision or a regulation comes about which impacts the company a little bit, then you would be the best judge of what you should be doing with that particular stock. So yes, do a barbell approach and buy companies or ETFs about which you have some knowledge or some idea, or probably you can speak about a company in 3 lines at least. So this has been something that we firmly believe in.
Yeah, that's a great point, Appy. And what I would recommend is, let's say about financial services, you don't know anything about financial services, right? And you don't know whether bank A is better than bank B. Buy an ETF. That way, you have exposure to the sector, but you also don't lose out with a particular bank's decision, and you're not sure of what that means for you and you as an investor, right? So that's a great point, Appy, to call out as well.
Yeah, so this is it, folks. I hope you liked this episode, and if you have any comments or suggestions, feel free to mention it in the comment section below, and please do subscribe to our channel. It really helps us. We'll see you in the next video.
Thank you, folks, for tuning in.